invite Dr. Vighneswara Swamy, ICFAI Foundation for Higher Education, for his paper on GUT theory.
So with the permission of the chair, let me begin. Good afternoon all. Firstly, I thank the IGPC and also IIMA Ahmedabad for inviting us to present our research work here. I hope this presentation gives a new perspective about how the public trust plays a very important role in moderating the gold prices. Let me begin, because the time is very less, only 10 minutes now they have told us. Gold is again repeatedly back in focus in all our discussions, especially in the markets particularly, and it has grown in terms of its prices enormously in the recent decades. Very high prices, always a concern. And of course, the strong central bank demand, and of course, the safe haven appeal. All these factors make gold, which is most demanded, and in the process, the prices are also skyrocketing. Now, what is this gold uncertainty trust theory? This is the proposition that I am making, a new perspective towards understanding gold, which I call it as gut theory. That means when uncertainty is very high, obviously the investors tend to look towards gold as their safe haven. And in the process, the prices also go very upward, too much. In the process, very many people who are not so good in terms of economy, monetary terms, they cannot buy and invest in gold. In the process, okay. Mic is on.
Yeah, mic is on.
You can go on. I think they are looking at it. Yeah, it's back. Thank you. So let me go faster because the slides are in large numbers, but I have to cut short it because of the time constraints. So now how this gut theory is proposed, I felt like this. There is uncertainty which is propelling the gold price. But on the other side, if you look at it, the public trust is one lubricating aspect which can moderate the prices of the gold. When I was doing research using this public trust for some other purposes, I felt that why this public trust should not be considered in the realm of the research of gold and see how it is going to impact on the gold prices and also on the uncertainty. So that's the result of this kind of a idea. So what actually I say here is, gold usually thrives in uncertainty, what we call as the safe haven. It addresses a critical gap in the understanding of gold demand. And this insight, that is, the public trust acts as a brake on this relationship between uncertainty and gold prices. The key hypothesis is the high public trust will lower the gold prices and also moderating the impact of uncertainty during that point of time. So the policy impact can be crucially understood as the impact of trust and its act on the gold prices can be understood very reasonably well. Now, trust as a stabilizer in the Indian context, if you look at, whenever the public trust levels are very high, the gold prices have been moderated. That's what the data says. Whenever there is public trust under very low levels or is under uncertainty, it is fueling the economic uncertainty, market uncertainty. In the process, the gold prices are also shooting up. That's what we see even in the gold context, in the Indian context also. So what the gut theory can be proposed is the public trust as a moderator between the economic uncertainty and gold prices. The higher uncertainty drives the gold demand. Public trust acting as a social catalyst moderates the uncertainty's adverse impact on the gold prices. Increased public trust stabilizes the gold prices by reducing uncertainty effects. So the relationship can be hypothesized as like this. When uncertainty index is going up, the prices of gold are also going up. But when the public trust levels are going up, the gold prices cool down. This is what the hypothesis that we are going to test and provide the empirical evidence. I will just skip this because in the interest of time, the theoretical framework I have modulated based on the available theories, available understandings about the theoretical pinnings about the public trust, uncertainty, and also the gold demand. So what are the research objectives here? Quickly. One is to quantify the relationship between uncertainty and the gold prices in the top 5 gold demanding countries. So we consider here the top 5 gold demanding countries in the world in the recent decades. And also we analyze how public trust moderates the impact of economic uncertainty and gold prices. And finally, we also compare in these countries, how is this working? Whether the gold uncertainty theory, what I'm proposing, the gut theory is working or not. So the data comes from the well-established, highly reputed sources. The data set is very large, around approximately 900 plus data points for each variable. That is a monthly panel data from 2008 to November 2023 for all these 5 countries we have considered. That is the China, India, Turkey, UK, and United States. And the key variables that we are looking at in this entire analysis are the gold prices, economic uncertainty, public trust, and also the control variables like the CPI, that is the commodity price index, and then PIR, RBER. Okay, fine, I will move fast. So this is the theoretical postulation, the equations that explain my new theory, that is the gut theory. And the hypothesis, of course, you can easily understand this. The methods, of course, very rigorous econometric methods I have used here. The sophisticated methods, the panel co-integrations, and then panel quantile regressions, and also the Wavelet methods to provide advanced understanding about this, this particular theory in different countries also. And we have done a lot of robustness checks. It's a very large exercise, but 10 minutes is a very small time. Still, I'm running fast. And these are the descriptive statistics. And it shows how the bivariate distributions and the correlations amongst these variables can be understood quickly. This is one interesting diagram, the car diagram of interrelationships. How these variables are interrelated, and it itself shows very nicely a visual representation of the importance of public trust. How public trust contributes, as I postulate in my theory, that is gut theory, how it is contributing to the gold prices and also the uncertainty index. So it is very nicely visualized and captured here. And then the quantile regression results also support my viewpoint that the gold prices are impacted negatively by the rising public trust. And of course, we also support the safe haven theory, where whenever the uncertainty is very high, the prices also tend to go up. And then in this quantile regressions, I have used with public trust and without public trust to show you how public trust plays a very important role and what is that moderating impact. Under the different quantiles, as you go up in the ladder of the gold prices, how the impact of public trust is at the higher quantiles and at the lower quantiles. So all this analysis is beautifully captured in this research. And we also use the interaction model. In this, when public trust interacts with the uncertainty, how it is impacting on the gold prices. So this simple diagram captures the coefficients under the quantile regressions at different quantiles, that is 5 important quantiles, and how the coefficients with public trust and without public trust. You can see here the bigger coefficients, as the quantiles there, the impact is very high. That means we are trying to tell you very clearly that with the evidence of this analysis, whenever the higher gold prices are there, the impact of public trust is also very high. And one interesting, another IC point I could find out, whenever the public trust is very less, it is not moderating the prices of the gold. In a way, it is also contributing for increase in the gold prices. So that means extremely important and observation we need to know. Whenever the public trust is very low, it is fueling the gold prices. But on the entirely opposite side, the contrasting side, whenever the public trust is very high, it is bringing down the prices of gold. So this is a very interesting is the impact of public trust on gold. Of course, I will close within a few seconds. Yeah. So these are the quantile regression results. And then I also did the analysis for individual countries to test my hypothesis and this theory for China and then India. So these are the wavelet analysis results for these two countries, which are also supporting what I did in the main evaluation using the quantile regressions and the co-integration analysis. Yes, I'm closing. So this also, I use the causality analysis to show further evidence in support of my theory, how there is a causation moving from the gold price, the public trust to the gold prices, and also public trust to the uncertainty index. So this is also shown here, and this research supports the ideas what I mentioned. Quickly, I will move up. This is the gut dynamic which I have captured in one single visual, where we can see in these areas where this green and gold, these blue colors are there. No, that is the area where there is the impact of high public trust on the uncertainty index as well as the gold prices. So I straight away jump to the policy implications. I will take just 2-3 seconds, that's all, and then I will close. For the investors, what is this theory telling us? In a strategic framework, what we can say is it helps navigate the market fluctuations during the uncertainty times. And the investors can take informed decisions based on this theory. They can incorporate trust in their indicators to understand the investment strategies and play those strategies. And also a broader asset allocation can be made based on this kind of an understanding of the public trust role in containing the gold prices at the very high levels. And for the policymakers, it helps us understand how public trust has to be encouraged in the entire society, in the entire economy. Because the trust in the government, trust in these institutions is a very important part. So that has to be encouraged and energized by the government. It has to be influenced by the governmental actions and the institutional actions. So that's why the policymakers can take a look at this important observation, and the enhancing transparency in the institutional mechanisms and the policy actions, accountabilities in the institutional performances, and communications, clear, transparent communications. That's very important. If that is encouraged, automatically public trust also goes up. In the process, you can moderate the impact of these high gold prices. And of course, it also helps the policymakers to look at the economic resilience of the economies. And for the research scholars, a new perspective on safe haven hypothesis is provided here through this theory. And beyond gold, that also can be used for different asset classes to do further research. And also longitudinal studies can be taken up using this kind of a new theoretical approach. That's what my contribution in this. With this I close, I don't want to take extra time. So finally, the gut theory is a paradigm shift, which I'm proposing towards understanding the importance of public trust in containing and moderating the gold prices at the very high levels of uncertainties. Thank you very much for this opportunity.
Can we have questions?
Yeah, the chair has to say.
Just can we go to the slide a little, 2 or 3 ahead?
Yeah.
The key finding or something like that.
Oh, another one, they've already started there. Slides are with them.
There was a slide on key finding. Key finding 1 or 2. There are 2
Yeah,
key
yeah.
finding slides, right?
3 slides were there. I shifted, jumped
That's
them.
okay. In one of the slides, next is, you
Towards
have to
the
go
end, you are
towards
saying.
it. You have to go towards the end. So, in one of the things that you said, high uncertainty, low public trust, and no back.
Correct, you're right, you're right.
Yeah.
Your observation is right.
It was
High
fine.
uncertainty, low public trust, very high gold prices. That's what the interesting observation. You are very right.
Okay.
Whenever the public trust is low, it is dangerously contributing for the high levels of gold
Who
prices.
do you call as your public?
Pardon?
Who do you call as your public? Buyers?
No, public trust is it's based on the survey which is done across the country. Since last some 20 years, they have built
In that case, who are your
index.
surveyor?
Yeah, I'm going to just explain that. As per the well-established mechanisms, this public trust is ascertained by the value-based surveys across the countries, across the world, where they look at the trust of the public in those public institutions of that country, and also the public governance mechanisms. The governments, the institutions, the important functioning aspects of that mechanism, that entire economy. On that basis, the public trust levels are understood and they are also indexed. So that is taken by a very well-established
Thank you. Thank you.
resource.
I think it's a good point. Basically, I understand. I'm not a statistical expert. That is one reason why the same global event, maybe in Turkey or Egypt, the price will be very, very different. And in India, it will be different. Because here you have, at this moment, you have more confidence in the government, where it is also, there is a local factor, like you don't have confidence in the industry, whatever it is, then the price of gold there will react more violently there. I think it's a good...
Sir, to support your point, you pointed very nicely. Actually, I had some information about that only. For example, when we made this comparative analysis of these 5 countries, what I noticed is China has a very high level of public trust. That's why the price of gold in China is lesser when compared to India and even Turkey. Turkey has very low level of public trust. There the prices are comparatively higher. So as you rightly said, in those countries where the public trust is quite high, we have seen consistently over a period of longer periods, the gold prices are reasonably lower when compared to the countries like India, where there is still lack of public trust. And our public trust levels are not so high when compared to China and also UK. So this is one of the interesting observations I could make in this analysis.
So this lower and higher is with respect to the purchasing capacity of that particular country, right?
You are talking about the gold prices?
Yeah, you are saying that China, it's
No, that is
considered
about
lower.
the public trust I'm saying.
No, public trust is higher, so the gold prices are lower, you said.
Correct, yes.
And that is compared to the purchasing capacity there, isn't it right?
Yes, obviously.
Yeah. Other things are taken, but the public trust role we are highlighting.
The rate of increase, the rate of premium, whatever.
Yes.
Thanks.
Thank you very much. Thank you.
Just an update on our schedule. We had moved up our paper presentations, which were scheduled for the afternoon because K. Rajaraman would be joining us only in the afternoon at 3 o'clock. So going for the next paper, I invite Ms. Bisma Raina and Professor Samaresh Bardhan from IIT Ropar.
Good afternoon, everyone. My name is Bisma Raina, and I'm from IIT Ropar. Yes. Okay. I'm from IIT Ropar. and I work under the supervision of Dr. Samaresh Bardhan, and today I'll be presenting on interactions of geopolitical risk, economic policy uncertainty, and market volatility with stock and commodity markets, evidence from India. The outline of my presentation will be, I'll start with an introduction, followed by the main objective of my study, the variables used, the empirical framework and methodology, and I'll discuss the results and analysis, followed by discussion, and conclude with some major policy implications. So as we all know, financial and commodity markets, they constitute integral components of the global economy. Financial markets mainly reflect economic activities, sentiments, fears, and behavioral patterns of investors. And commodity markets, on the other hand, have in the recent times emerged as attractive investment areas for investors. We have seen a surge in commodity and trading in the commodity markets, particularly in the precious metals like gold and silver. However, the global financial landscape has undergone significant changes because of increased macroeconomic uncertainties around the world. For example, there have been an increase in the geopolitical uncertainties around the world, and due to interconnectedness in the global markets and spillovers across assets and markets, these uncertainties have country-specific effects and global effects. So uncertainty has effects on economic activities. It's through three main channels. The first is the real options theory. The second is a global decline in industrial output, and the third is via the banking sector. So real options theory says that the investment and uncertainty are interconnected via a wait-and-see effect, wherein firms decrease their investments and hiring, and this in turn leads to a decrease in the economic growth. Global decline in industrial output also leads to a decline in the growth, and banking sector also lowers the values of its own assets. So the main objective of this study is to investigate the dynamic interactions between key macroeconomic uncertainty indicators, which include the geopolitical risk, economic policy uncertainty, and the market volatility, and different asset classes in stock, commodity, and energy markets. The major contributions of the study are, in the prior literature, studies have been mostly conducted cross-country studies, but this study is basically based on the emerging market economy India, wherein in a unified framework, we take into account major uncertainty indices and capture their lead-lag relationships and co-movements with stock, commodity, and energy markets. Secondly, in this study, we analyze the correlations and lead-lag relations in a time-frequency framework using the Wavelet coherence approach. What this model does is it takes into account the preferences of both short and long-term investors. And thirdly, what happens when macroeconomic uncertainties hit a country? Basically, investors approach the flight to quality phenomena, and what happens there is they prefer safe haven assets. So in this study, we also examine how gold and silver act as safe havens in the Indian context. These are the variables used, their description, and the source. So the empirical framework and methodology, we adopt a two-step methodology. First of all, we use a wavelet coherence approach, and later we use a DCC-Garch model, and we use it as a robustness analysis. The equation given, it depicts the co-movements between the two time series, wherein the RXY ranges between 0 and 1. 0 depicts zero correlation and 1 depicts very strong correlation. The second equation is the DCC-Garch model is given, wherein HT depicts the 2x2 conditional covariance matrix and RT and DT depict the conditional correlation and diagonal matrices respectively. Now in Wavelet, heat maps are used to denote the results, and what happens in heat maps, we have basically the color ranges from warmer tones to cooler tones. Warmer tones represent stronger correlation and cooler tones represent less correlation, and it's in the form of arrows. The up arrows, vertically up arrows show that first series leads the second, and vertically down shows that second series leads the first. Then we have down right and down left. Down right and up right, they depict positive correlation. Down left and up left, they depict negative correlation. And horizontally right, positive correlation, horizontally left, negative correlation. This is the first diagram which we have. We have taken, first of all, GPR, geopolitical risk, which is India-specific, and later on we take world-specific in order to see how these two geopolitical risk indices affect the Indian market. So in case of GPR India versus BSE 500, a strange thing is noticed, which is that the two are positively correlated, whereas it's seen that stock markets generally have a negative correlation with GPR index. But since Indian market has shown strong development in the past few decades, and also GPR India is a temporary, the geopolitical events that happen in the country are temporary and country specific, so BSE has a positive relationship with GPR India. And mostly we can see in case of gold, in case of silver also, these are in the long-term, long-run frequency bands. Basically, we have divided the frequency bands. 2 to 4 is the small frequency band, 4 to 8 medium, and above 8 is the long-term frequency band. GPR India has a positive, mostly positive correlation with crude oil also, because you can see the arrows are mostly the arrows are positive, are upright and downright, which depict a positive correlation with GPR India has with crude oil. Now this is with the world-specific GPR. In the world-specific GPR with BSE 500, a negative relationship is observed. As you can see, down left arrows are observed in case of GPR World and BSE 500, and rightfully so, because world-specific events, they lead to supply shocks and other things, that affects the outflow of FIIs and other things, so it has a negative correlation. Gold acts as a hedge. Silver also acts as a moderate hedge, as we can see the positive, the right aligned arrows. Crude oil has again a positive relationship, mostly seen since we can see the upright and downright arrows. In EPU, we observe a different kind of relationship. First of all, the EPU versus BSE 500, all down left arrows are observed. So it has a negative relationship with EPU. Why? Because EPU is basically policy uncertainty, and BSE 500, what we can see is those policies can be different, monetary policy and other things, how the market interprets those policies. So BSE 500 has a negative relationship with EPU, which is rightfully so. And EPU, gold and silver do not act as hedges against economic policy uncertainty, whereas they act as hedges against geopolitical uncertainty, because in case of geopolitical uncertainty, it's the risk aversion of investors is seen, whereas in case of economic policy uncertainty, different kinds of basically policies are taken into account. For example, if there is an interest cut in case of a monetary policy that's being followed, the investors will definitely prefer stocks over gold. Crude oil, a negative relationship is observed with EPU, because in case of GPR, there is a supply shock, and in case of EPU, demand shocks will be observed. So a negative relationship is observed. Now there is VIX. In case of VIX, the most strong relationships are observed, because VIX is an objective measure of risk, and whereas the prior there are newspaper-based risks and there is a lag involved, and VIX represents risk aversion in the most appropriate format. So we can see in case of BSE 500, total negative relationships. Gold is a very strong hedge against VIX, silver is a hedge against VIX, and crude oil also acts as a hedge against VIX. This is the DCC gauge, wherein we have given the DCC gauge correlation coefficients. There is a discussion that is in case of, I'll discuss it very briefly. We can see that the newspaper-based indices, they have long-term memory, so they affect the different kinds of assets, majorly in the long term, whereas VIX affects all assets in both short-term and long-term, because VIX is basically an objective measure of risk, and it represents risk aversion in the most appropriate format. We have some conclusions and policy implications. Basically, the government of India can promote gold as a diversifier, because it acts as a strong hedge against GPR and also against the VIX, and also related to oil, crude oil, since crude oil is positively related with GPR. So keeping in mind how the geopolitical that India occupies a strong geopolitical space in the world, so it should take measures to strengthen its geopolitical positioning and accordingly take steps to prevent its economy from falling into some major traps. Thank you.
So, at the end of this study, what you have said is the government should promote using gold to diversification. Is that the key thing?
As a diversifier, as a diversification asset, gold can be used because it has proven to be a hedge against geopolitical uncertainties and also against the market volatility. However, against the EPU, it doesn't act as a hedge, and that has been proven in some other studies in Chinese context also, that gold's hedging properties are asymmetric, they are not symmetric. So in case of India also, the hedging properties are asymmetric, whereas in case of geopolitical risk, because of investors' risk aversion and geopolitical risk basically is very sentiment based. Investors quickly react, so it acts as a hedge. They resort to gold. Whereas in case of economic policy uncertainty, it depends upon what kind of policies are being implemented by the government. They take steps like according to those policies only.
So when you say, like, now Trump is bringing this tariff thing, would
Yes,
that be a geopolitical risk or a EPU?
Sir, basically, I have taken an India-based study.
Okay.
So I have taken into account only those policies which will be implemented by the government of India.
By the government of India.
Yes,
Okay.
sir. So that will have an effect via, because all the countries are now interconnected. So whatever policies are being implemented by the US government will have an effect on Indian government. But I have taken into account only those policies which will be implemented by the Indian government.
So it is not a hedge against EPU.
Yes, sir.
But
has
it is a
not been
hedge
found.
against the global, like a
Yes, sir.
Ukraine war. It is a good hedge. That's the understanding.
So
Okay.
even against India-specific GPR, also it has been found a hedge, and against the world GPR also.
Okay, fine.
Yes.
Can I ask one question?
Yes, sir.
So, can you quantify how much of it? So, you mentioned about portfolio diversification.
Yes, sir.
So, any quantum like 5%, 10%? What
No,
kind of?
Sir, basically it is a time frequency analysis. So what we do is we capture the effects across time domain and across frequency domain. So it's not a particular quantum, but it has been found as a hedge against VIX, a strong hedge, because we can see all those islands with strong red colors which denote a strong coherence. And whereas in case of GPR, it is a weak hedge because GPR, those are not localized, the effects are not localized. In case of VIX, the effects are localized. So in that context, we have carried out the study.
Thank you.
Thank you, sir.
Thank you, Ms. Raina. For the last paper of this session, I invite Dr. Mujeebu Rahman and Dr. Shahul Hameed from PMA SAFI Human Resources Institute.
Hi all. So after the two rigorous quantitative presentations, let me come up with some of the sociological insight from the retail industry based in Kerala. So I hope at least some of you are aware of this place called Koduvally, which is one of the densely populated, densely packed small town in Kerala, which has 100 plus retail, independent retailers in one hub. So this has been in news for all the wrong reasons, unfortunately, but there was this interesting news about this particular place in last month in Madhurabhumi, and this ex-bureaucrat is talking about the potential of this place to convert it into a golden hub, in that sense, to connecting it with other small towns in Kerala and cities like Kochi and also Kozhikode and Kannur and Kasaragod and Koduvally being the buckle of the belt. Talking about a potential of having like a golden belt, like we have a mining belt across the country. So they're talking about the potential of that, particularly in a context where Kerala is looking for more tourists are coming into the state. And so our curiosity from a sociological point to look at, first of all, this particular town, to try and understand how come this much retail independent retailers are working in same space, and how do they negotiate the policy changes and also the presence of the corporate retailers around, and also to see how do they tackle the market formalization and also the evolving regulatory framework. So let me begin with a policy change happened recently in the Indian context. There have been different policies which impacted the independent small retailers, and one among them was the latest among them was the custom duty change from the 15 to the 6%, and it was expected that it will curb the smuggling. And obviously, from a formal retailer's perspective, you can read out MP Ahmed's quotations just after the policy cut. He was expecting that it will improve, it will obviously tackle the smuggling, which obviously will impact the small independent retailers, because it's been claimed that they do source their gold from the informal sources, and they could sell it in a cheaper way than the formal corporate retailers. And because of there isn't much price gap between the Middle East and also Kerala, maybe India right now, there isn't much motivation for the smugglers to smuggle and for the small independent retailers to sort of source it. Rather, they'll be forced to sell it with the GST, and which obviously will impact their sales. And it was expected that the customers will go to the formal retailers. And you can see that again from his quotations, and you can see that there is an impact in the gold smuggling. It has sort of went down. And we also need to read it and juxtapose it with the recent report about the Indian customers that the millennials are moving into the formal retailers, and big malls in India are getting more jewelry and the millennials are moving into it. So we need to juxtapose all that in one frame and see, from a retail corporate perspective, they saw it as a positive sort of an impact in terms of sales and also in terms of making it a more formal market. So, and you can see it's more of resonate with the gold jewelry demand in the Indian context. You can see the quarter 3, just after the policy cut, there was a surge in the demand of the jewelry, around 18% surge, whereas there was a 12% decline in the whole world jewelry industry. So my curiosity was try and understand then how this particular hub sort of negotiate that policy cut. So we have done a set of ethnographic interviews. So Koduvally comes from, it's in between the Calicut and also the Wayanad. It's one of the, it's on the way. So we have done a couple of ethnographic interviews. We've also done a market mapping in order to understand who are the key stakeholders in this particular hub. Are they only retailers? Are there any other stakeholders also playing a key role in this particular hub? So we really wanted to sort of, see and understand the spatial organization of the market and also the geographical sort of spread of the retail clusters. So we sort of started with mapping the small independent retailers in this particular town. So in just 500 sort of meter belt, you could find around, so according to the merchant organization, there are 116 retailers. And so we had this curiosity to try and understand how many of them are really functional. So we came up with, from the Merchants Association's point of view, there are 86 of them are with proper GST, with the papers, but we still had a confusion, are they all functional? So we took a couple of days to try and understand how many of them are really functional. So we sort of pointed it out, and we found 70 plus of them are really working in every day. They're getting customers in and they're opening every day. So you can see different names from Arabic to Sanskrit to to English, all different names and different sort of retail shops. So again, when we talked about the it's a different lines. So one is in green line, and so we just wanted to sort of make it 4 lines. One is in green and one is in violet, and the blue and the black, just to sort of give you that different belt. To give you that idea. So to talk about that, the impact it made just after the custom policy cut. So they said, obviously, there was a surge of the demand in the quarter 3, and according to them, it is because of the fluctuations in the price. There was lower fluctuations, but when it comes to the quarter 4, there was high fluctuations, which obviously impacted the sales. And the quarter 3, they sort of sourced the gold through there was a lot of surge in the sales of old ornaments. So they could source it, and they could sort of also in fact involve in that sort of selling process in the quarter 3. Unlike the formal corporate's explanation that there was a surge in the quarter 3 because of the lot of documented sales happened. So this is from their perspective. Then, but beyond that, there are different ways they negotiate with the corporate sort of retailers around, like Malabar, like Joy Alucas, like the Bisma, and so on and so forth. So first of all, when we looked at who all are these retailers, So they're coming from either Wayanad or from the northern part of Malappuram or a different part of Calicut. So they bring in their customers into the market, into the local retail market. So it's very much based on the trust they created. And we had this confusion regarding hallmarking, because they were hesitant towards that initially. But the saying, right now, it's sort of, in a way, sort of solidified the trust they have, because now there is a formal certification process. And according to them, Kerala is one of those places, is the only state in Kerala, only state in India having all the 14 districts having a hallmarks centers, and Koduvally has among them. And so it sort of solidified the trust they have with the customers, and more importantly, they focus more on the traditional jewelry. You won't find much jewelry for the millennials, but for the older generations, you find the ornaments like chit, and they comes up with all the different sort of designs with it, and they have a huge customer basis for that. And more importantly, other than different from the corporate sort of retailers, they're focusing more on small purchases, So you won't find much wedding purchases in this particular market. Rather, they're going to be like Malayali sort of, purchase gold for different other ceremonies. And you can see that from the data. So if you look at the per capita consumption, like state-wise in the Indian context, in rural India, Kerala is on the top with 208 rupees, and in urban India, Kerala is again on the top with 189 rupees, and the second state is much behind. But when it comes to jewelry purchase, you can see that Malayali braid again on the top, but the second position isn't much behind. So, which means that Malayalis do purchase, gold ornaments for different other ceremonies, from childbirth to the puberty to different other ceremonies, and this particular retail market is focusing on that. And more importantly, you find through our ethnographic mapping, we found that there are a lot of wholesale dealers working in this particular market. So they do have manufacturing unit, and they also have independent manufacturing unit. So they said that earlier Koduvally used to have a lot of manufacturers along with the small independent retailers, but right now you can find that there are a lot of independent manufacturers working around 20 plus, and 10 of them are from Bengal. So there is this competition from a retail's perspective. They can go to any manufacturer for any design. So there is this bargaining space, and also there is a space for both manufacturers and the retailers. And the wholesale dealers, beyond having manufacturing units, they also have connections with Dubai and Mumbai. So they come up with all the new ornaments. They say that they bring it first to the Koduvally, then from there they sort of distribute it across Kerala and across the South India. So for example, we went to one of the shops, and they come up with this new necklace and saying that, this is one of the pieces just came in yesterday, and you won't find it anywhere in other jewelries in Kerala, because we get it from Mumbai directly, then we distribute it from here. So you get all those new designs there, and the manufacturers and the karigars get that design ideas, and they design it and distribute across Kerala. And so from drawing on Barbara Harris White and rest of the scholars, I could sort of explain this market as a clustered economic development within the informal and the shadow economy, because more than jewelers, though visibly you find a lot of jewelers, it's a market with a lot of manufacturers, wholesale dealers, banks, associations, and the pawnbrokers, and also Hawala. So in a modern capitalism has seen having distinct type of clustered growth based on the principles of zoning, but not all zones are very much based on the formal sort of structures, but there are zones which, informal, and also very much sort of based on the trust and also informal network. So it sort of thrives through that spatial proximity, where informality is not merely byproduct of weak regulation, but an economic strategy of market like this. So it gives them a spatial proximity, which helps to helps for the flow of the capital and the commodity, which also help the flow of the informations with regards to design, trends, and all the gold prices. It also sort of helps them to subcontract and sort of deal with the other key corporate players around. And it also gives them active collective efficiency in terms of trade associations involving and negotiating with the key players. And also it helps them to sort of adapt to the market because of the informal sources they have. And it also improve and sort of maintain the cross-border network, sourcing raw materials from different other part of the country. And so you won't need to sort of look at this particular market as something very unique. Rather, it can be understood within the broader patterns of economic specialization in the Indian context. And interestingly, this market is, sort of multiplied and reproduced through the social reproduction and kin-based expansion, which means that you won't find much big jewelers over here. You won't find any big brands sort of emerge from this particular context. Rather, you find that new jewelries are coming in. And it comes through the kinship relationship, So for example, the very first jewelry retailer, independent retailer, was the Farooq Jewelry. You won't find Farooq Jewelry here because it completely disappeared. It came in 1930s, but the dinar is actually started by his nephew. Right? So his nephew is starting a new venture, then the son will be starting a new venture. So it's been sort of multiplied over a period of time. And the second jewelry, which was MPC, again a cousin of the Farooq Jewelry, and he came up with this idea. You can see that old advertisement which I found in the field, but if you look at in the market right now, you won't find that jewelry over there because completely disappeared, because they shifted into a hospital and the clinic industry, and their sons are getting into new other industries. And the third one, which came in the 1950s, that still remain as a small old shop. It never sort of expanded or never got into that formal sort of network. So I had this curiosity, then why don't they grow big? Having this much sort of number of retailers and having this long history of gold retail industry, why don't they grow big? So it's mainly because of this clustered growth and also because of the fragmented sort of the multiplications. For example, we found this was an innovative idea by these small retailers to come up with a big shop. So it's called KGM, which means Koduvally Gold Merchants. So they wanted to come with a big shop in order to compete with the larger sort of corporates like Malabar and the Alukas and so on and so forth. So 40 of them came together and pooled capital and came up with this new shop, but it disappeared in 2022 because you won't see that right now in the market, because all the customer basis for this particular KGM Gold was the individual customer basis of the all the retailers, which obviously ultimately impacted their own sort of customer basis, and they sort of withdrew from that and it's completely disappeared. So you only find this small number of shops are coming in, and interestingly they are investing in some other jewelries instead of accumulating more capital. So you might find one jewelry, he must have investment in the next jewelry. So instead of accumulating and coming up with a new big jewelry. So that's all about the story from Koduvally, and thank you so much.
It's a very interesting subject, because our question is, even in Bombay, King's Circle, why do these people stand in such long queues to have idli vada, dosa, whatever it is. You never understand Mani's Cafe, Madras Cafe, Mysore Cafe. The question is always there, why can't they just put up a huge one? Because there will be people coming. But they continue to remain as they are, and that's perhaps what we like. So your study has implications for the entire Indian psyche, I think, quite a bit of this thing. So very interesting study. Is it available in the website or anything? Or?
No, we can share the paper with you.
Yeah,
sure.
Just an interesting study. So well done. Thanks.
Thank you so much.
I think, it's a very interesting paper. One of the enlightening things I heard from anyone in recent times is, the decision to not grow or informality is a economic strategy and not a byproduct of a weak regulation. It is very enlightening. Very enlightening. This particular statement would remain in me for a long time. And I think I'm going to use this statement for other things when I'm going to communicate with the government. Thank you very much.
Thanks so much.
Well done.
I just want to actually congratulate you. You went into the ground level and tried to understand what exactly is happening. It's actually eye-opener for all of us. So congratulations for that, actually.
Thank you so much.
For example, if I'm going to talk about, I do a lot of things about transportation, logistics, supply chain, right? In certain sectors, I always see there is no place for small players. For example, if you look at shipping and all, small players find it very difficult. Here, the only way in which small players remain is to stay informal, quickly move on. Good. Thank you.
Thank you so much. No questions? Okay, thank you so much.
Thank you for the great presentation. Now I invite Sundaravali ma'am to felicitate the session chair and award certificates to the presenters. Yes, the presenters, please come forward. First one, the first award to Dr. Vighneswara Swamy. The second one to Ms. Bisma, Raina.
All the three were very good. Really, even for a person who is not into all these statistical tools, it was very well.
And the third one for the paper of Dr. Mujeebu Rehman and Dr. Shahul Hameed. Thank you, everyone.